the introduction part, which is a Markowitz portfolio theory (MPT) developed by Harry Markowitz in 1952, revolutionized investment strategies by introducing mathematical models for portfolio construction. It emphasizes the quantitative benefits of diversification and the importance of combining assets with non-correlational returns to minimize unsystematic risk.
This study contains two main objectives, which is to study the main component in Markowitz portfolio theory and to analyze the effect of Markowitz portfolio theory in investment concept. From the aspect of methodology, this study was conducted using secondary data. According to Numerican 2005, secondary data can be defined as a data have been collected by the other researcher. In carrying out the study, the researcher obtained data related to the Markowitz portfolio theory to indeed and investor idea about the theories used in the investment concept. Researchers also obtained information about the Markowitz portfolio through newspapers such as Berita Harian and the Economic Times. In addition, some data was obtained by researchers through journals such as the Global Journal of Business, Research and Corporate Finance, 6 editions.
There are 6 main factors available for this theory, which are expected return, risk correlation, efficient frontier, asset allocation, and risk-return trade-off. Here, the expected return indicates the profit or loss by investor in an investment. An investor tends to avoid high-risk investment with unknown risk. In this example, we can compare that the calculation for the first asset is 4%, while second asset is 2%, which indicates that the investor will choose the higher expected rate of return. The next instrument is correlation. Markowitz recommends that all researchers use this model to gain new perspectives. In this model, the price of asset tends to move with the same direction with trends. For instance, asset A and asset B have 1.0 correlation, which means that both are positively correlated. One gains 1% and another gains 1%. The Markowitz model suggested that risk can be minimized by using standard deviation. After obtaining the expected return, investor needs to choose the risk model that can quantify the level of risk. For example, the returns on stock A is expected to be 8% with a probability 0.6 and 10% with a probability of 0.4. So before calculate the standard deviation, we must calculate the annual expected return for stock A. In this case, the initial expected return is 0.088 and the latest expected return is 0.00784. After that, we calculate the standard deviation in square root bracket 0.00784 minus 0.088 power 2 equals to 0.00979. This indicates when value of standard deviation below 1, it indicates the investment is less risky.
Next, the main component in Markowitz portfolio theory are the efficient frontier. An efficient frontier is a graph curve that illustrates the correlation between risk and return for a group of portfolio and can be applied in several methods. Therefore, the issue of determining the ideal level of diversification can be resolved by the efficient frontier graph. The efficient portfolio is the one that presents the greatest return at particular level of portfolio risk. Due to the benefit of diversification, Markowitz efficient frontier theory can enhance expected portfolio returns without raising the risk. Therefore, efficient frontier can help investors in identifying portfolio that produce the highest return with the least amount of risk. Next is the asset allocation. Markowitz proposed a way to arrange a suitable asset allocation decision for investors and is greatly influenced by their risk tolerance because each investor's portfolio has a diverse composition. Asset allocation in the portfolio is to measure the percentage of each asset trade-off in order to balance investor risk and rate of return. Investors can lower the risk and increase the variance of return in their portfolio by diversifying the asset among several asset of classes. The optimal approach to asset allocation is to allow a global perspective in various industries and sectors to provide the portfolios. Therefore, allocating assets in a variety of industries is one of the investor's practical options to achieve the optimization. Lastly, risk-return trade-off. In Markowitz principles state that the greater the investment level of risk, the higher the potential return. A greater potential return is associated with higher standard deviation and a higher risk. If the higher the risk, investor will demand a greater risk premium. The risk-return trade-off cannot guarantee a higher return on investment, rather, it points only to the possibility of higher return, and the higher the portfolio's volatility, the higher the risk will be. Therefore, by combining these main components, Markowitz portfolio theory provides a framework for investors to establish portfolio that provide the least amount of risk for a given level of return or the highest return for a given level of risk. That's all from me. Thank you.
Now we will enter to positive effect of Markowitz portfolio theory. There are got three positive effects that have been considered by researchers. First is diversification of risk. This way help investors to manage the investment plan in a manageable way to reduce investment risk. Investors can diversify their investments to more stable investments such as fixed deposit, bond, money market instruments, precious metal investments as gold, and others. Secondly is quantitative analysis. Quantitative analysis be used to identify patterns in the guidance for profitable securities trade in an effort to reduce investment risk. The pursuit, namely as risk-adjusted returns, contain various risks in assessment. For example, R-square, standard deviations, and ratio to identify investment that provide the best or higher return according to the funds invested in an investment. Calculation using statistical mathematical formula can be revealed stable and strong values and will be more easily discussed through the specific hypothesis. Lastly, academic and practical applications. It can be used as an investment technique and concept that can be learned and applied in the basic of investment and asset management for the Malaysian community. This investment theory can also be embedded in financial subjects that reveal the concept of prudence, investment for the benefit and future knowledge of students regardless of whether it is at a public university or private university level.
Good morning to Dr. Wong. I would like to present about the limitations of this theory. We all know that everything has pros and cons, so does this theory. One of the limitations is information equality. Based on the underlying assumption, this theory said that all investors receive the same amount of information where all investors are rational. However, in the real world market, we encounter the challenge of asymmetry information where some individuals have better knowledge than others. For example, investors frequently like hot industry or market that is boom due to the excess of speculative. The second limitation is higher risk is equal to higher return. In the assumption, all the investors are risk averse, meaning to say that they don't like to invest in the portfolio that is very risky. They will only to do so if they are compensated with higher returns. However, in the real world, some investors may like to challenge themselves by taking the risk to get the high returns. In fact, when the investor take high risk, it doesn't mean that they will get the high returns. There's a high probability they might lose their money in the investment. Furthermore, the returns are not normally distributed in the real world. The subprime mortgage crisis in 2008 is one of the unexpected economic events that is not normally distributed. According to Markowitz, he suggested that semi-variance is better than variance to measure the risk of the portfolio as it only considers the negative side of the investment. So the investor can know the probability of losing their money from the investment. Last, investors have unlimited access to capital, but in the real world, all the investors have credit limits set by the lenders. These credit limitations are different among borrowers according to their creditworthiness and financial history. And this assumption also didn't consider the market condition and liquidity when the investor want to access to capital. For example, if the market is on recession, it's become difficult for them to borrow the money since the money supply are decreasing during that time. That's all from me. Thank you.
Solution and recommendation for improvement the limitation of the model. We suggest two solutions for address the limitation on MPT model. First we suggest is Blake-Litterman model. This model is used to address issue and traditional mean variance optimization of Markowitz model theory. The purpose of the model is also to be used as a sophisticated portfolio construction method and overcome concentrated information and estimation error. This model is often applied to optimize asset allocation against risk tolerance and market condition and error reduction, which focus data divided into vector, expected return, asset price, and portfolio weight. The model combines rational investment decision or market view and investor expectation with historical data analysis. To conclude, this model provides more refined approaches than traditional model. Second solution is capital asset price model, CAPM. The purpose of the model is to evaluate risk and return in financial instrument with an approach for factors and occur in the economy such as inflation, economic growth, and so on. It also used to utilize financial instrument information to determine risk return outcome. This model is able to convey the level of systematic risk associated with forecasting stock return along with supported rational investment decision by helping investors understand stock condition and also recognize the alternative strategy based on the market condition. To conclude, these models offer insight into risk and return dynamic, helping the investor in making rational decisions and investment.
And for the conclusion, Markowitz portfolio theory revolutionized investment by focusing on expected returns, risk, correlation, and the efficient frontier. It enabled diversification across lowly correlated assets, reduced risk without compromising returns, and influenced modern portfolio theory. His contribution transformed passive and active investing and leading to passive index tracking and diversified funds dominance. And that's all from our group. Thank you for listening.